Hi, Paul McHugh, Income Property Organization, broker for Ohio and Kentucky. I'm here with Al Beachum, broker for Ohio and Michigan. How you doing?
How are you, Paul? Good morning.
Great. Last time you were the one asking me the question, so this time it's my turn.
I was. I'm ready.
Good, good. We were discussing rising rental rates and the population growth and population drivers
Correct.
last time and how that impacted each other. This time I want to talk about something a little bit more dynamic. It's capital markets. So we're hearing some grumblings about rising interest rates and financing. How would you say rising interest rates are affecting valuations right now?
Very popular topic, and the answer is it depends on the deal. So smaller deals in secondary, tertiary markets have been impacted. There's been a ding on valuation. Rental rates are rising fast enough to offset that in a year's time or so. However, there has been a knock. Larger deals, no knock, no ding. They size better for agency loans, and we're seeing interest rates, at least as of today, not far off from where they were 9 months, a year ago. So smaller deals, because they're tied to SOFR versus 10-year Treasury, they are pricing much better. So if a deal's larger in a better location, certainly a core market, a client can get a 80-20 or 75-25 agency loan. It's going to be in the mid to high fours on the rate. Might get some interest only. That deal is performing much better from a debt service standpoint than the smaller deal on a 25-year AM. That is probably, as of today, 5.25, maybe 5.5 at the worst. And in a couple of weeks, when the Fed moves money 50 to 75 bips, it's probably going to be inching in on 6%. So for the deals that don't size well for larger loans, they've been impacted more significantly. However, we are very bullish that those losses and valuations will be offset within the next year or so.
That's a good point. So it leads me to my next question is, how do the rising interest rates affect buyers and their target yield?
We have watched the buyer pool evolve as rates have risen over the last 6 months. And the syndicator was the winning bidder time and time again on openly marketed assets and even off market. And now the syndicator is losing out to the family office or the high net worth individual, the private partnership whose capital and equity demands are more flexible. They won't be in, quote, pref jail in a situation where they're beholden to a pref.
Sure.
And if they believe in the asset and they believe in the upside, certainly the rental growth they're seeing, they're comfortable making less money out the chute because long term they feel there's no better place for their money. So we've seen the buyer pool evolve a bit, but the equity demand is still there. And the syndicators still want to do deals.
Right.
It's just tougher for them.
Yeah, that makes sense. So,
And to follow up,
yeah,
we have not, in my opinion, seen much of an impact negatively from a seller standpoint on yield. Buyers have largely taken it on the chin because, again, recurring theme, the rental rate growth is so significant that equity seems to be convinced that it is worth it,
Right.
for lack of a better expression.
sure. And it is. It is worth it. Now, let me ask you one more question about then and now in terms about a year ago. Loan products. So if you were to sell me a 5.5 cap Class C value add deal, what type of loan products are we discussing now versus perhaps a year ago?
Same answer as it was to the first question. Depends on the deal. So if that is a small deal in a secondary, tertiary market, that is a tough deal to get done because you are going to be experiencing negative arbitrage on that. In 3 weeks, if we're negotiating that deal today and you're getting a term sheet on your loan, that term sheet's going to probably have a 6 on it from a bank, at least the high 5s. So unless that bank's willing to do interest only, or there's a big value add play, or they really like your personal guarantee, it's going to be debt service constrained. However, if it's a larger deal and it's going to be for a agency loan or some other loan product which is tied to the 10-year Treasury, which is not as expected to move as much as SOFR is after the next, that deal is going to be easier to get done. And that deal is going to, if it's an agency loan or even a bank loan, a larger loan for a regional bank that they would be competitive on, The hardest nut to crack now for that scenario is a value add or unstabilized deal. If it's a 5.5 cap on a little bit of pro forma going in, and there's a big value add play, that used to be a bridge loan all day long. 4.25, 4.5 bridge loan. We did a ton of those. You did a
Right,
ton of those. That party's over. Bridge debt's in the 6s right now. Right now, it's probably going to be close to 7 before the year's up. It's dead. So for your 5.5 cap scenario, for a big value add play deal that would normally just be custom fit for a bridge, that deal's not getting done unless the buyer wants to come in and put a ton down. And as expensive as the bridge debt is and the fees coming in and out, that dog doesn't hunt.
So it sounds like we're left with agency or local lending?
Essentially, but life companies are still active and love multifamily, albeit you're going to put 30+% down, unless it's a really, really nice asset and a great story behind it. So I think debt funds are going to evolve and emerge. I think you're going to see some lenders get creative because the appetite, given the operating fundamentals behind multifamily as an asset class, I think some lenders over the next year are going to emerge to backfill the space that's been created by the bridge lenders. I think some banks are going to step in and become a little more creative. That's my expectation.
Yeah. So in the grand scheme of things, though, 5.25, 5.5 interest rates, still cheap capital.
The bottom line is, I remind clients all the time when they're grumbling, capital is still cheap.
Still cheap. It's a great place to leave off. Appreciate your time.
That's all I got.
That's all I got.
Thanks.